Imagine waking up, checking the markets, and seeing nearly $2 trillion, yes, with a T, just wiped off the global equity map in a matter of days, all because of a tiny shift in how central bankers were talking. Welcome to today's Explainer. We're diving right into one of the fastest, most brutal macroeconomic repricings we've seen in recent memory. We've taken all the complex dot plot projections, the underlying labor data, and the Fed's aggressive tone shift and distilled it down to the absolute essentials. So let's just get right into it. What if I told you that a bunch of officials sitting around a table just tweaking a single inflation forecast could literally force the entire global financial system to restructure overnight? Think about it. High-flying tech stocks tanking by 20%, speculative assets completely falling off a cliff, and a housing market that was scorching hot just suddenly freezing cold? It sounds like a total doomsday hypothetical, right? Well, actually, that's just the mechanical reality of what happens when a heavily leveraged market has to adjust to a brand new cost of capital. The Federal Reserve didn't just change the rules, they changed the whole game. And when we talk about the cost of capital changing, we aren't talking about a standard 5% pullback here. We're talking about trillions. Trillions of dollars of wealth, money locked up in big institutional bonds, corporate valuations, your pension funds, just erased, evaporated. To give you a sense of the scale, during one recent repricing event, the S&P 500 literally lost over $1 trillion in market cap in a single afternoon. Why? Simply because bond yields ticked up by a fraction of a percent. That's the incredibly fragile, volatile scale of the environment we're operating in right now. To understand the panic, we have to look at Section 1, the rate cut dream. See, for the better part of a year, everyone from Wall Street institutions to retail day traders was living the dream. They were fully convinced we were coasting toward a series of rate cuts. Early inflation numbers were dropping faster than expected, and the consensus was, hey, the Fed did it. They engineered the soft landing. Everyone thought sheep money was coming right back. The market was basically positioning itself for the liquidity spigots to get cranked wide open again, expecting that cash to flood the system and push valuations right back to their peak. And you know how it is, that anticipation of liquidity? It acts like high-octane rocket fuel. We saw this wild, speculative run-up across the board. Stocks were rising, especially those mega-cap tech companies, because traders were essentially pricing in a return to 0% borrowing costs. Crypto was pumping, catching a massive bid on the promise of all that excess cash. And real estate? It got super hot again, entirely fueled by the hope that mortgage rates were about to plummet back down to historic lows. It gave the market this crazy feeling of invincibility, but it all hinged on the absolute certainty that the Fed was about to pivot. But then, Section 2, the Fed's plot twist. Wham! The reality check hit. Through their press conferences and updated economic projections, the central bank completely flipped the script. The new message? Rate cuts may not happen anytime soon. Higher for longer became the dominant mantra. The data was showing that inflation, especially in the services sector, was just incredibly stubborn. So in the blink of an eye, that baked-in guarantee of 6 consecutive rate cuts completely vanished. The central bank made it perfectly clear they were willing to risk some real economic pain if it meant hitting their 2% inflation target. And boom, the rug was pulled right out from under the market's bullish thesis. So now we're shifting rapidly. On one side, you have the low rates we were used to: cheap money, rising stocks, crypto pumping. It's an environment of endless growth where capital flows into risk freely. But on the other side, high rates, expensive borrowing, slowing business, and fear. In this new high-rate reality, the 10-year Treasury yield acts like gravity on equity valuations. Think about it. Why take a wild risk on a volatile growth stock when you can just sit back and grab a guaranteed, risk-free 5% return from the government? That fundamental shift forces a ruthless, system-wide reevaluation of every single asset class. Which brings us to Section 3, the high-rate domino effect. There's a very mechanical chain reaction that takes place when rates stay high for a prolonged period. Step 1. Borrowing gets prohibitively expensive. Just look at commercial real estate. There's a massive wall of debt maturing right now that has to be refinanced at double the old interest rates. That forces Step 2. Businesses naturally slow down. They freeze hiring and shelve expansion plans to preserve capital, which trickles down into Step 3. Consumers spend less. When people see a softening job market and they're staring at brutal credit card APRs, they close their wallets. And finally, that drop in consumption leads to Step 4. Corporate profits fall, completely missing Wall Street expectations. And when those profits fall, the sell-off isn't just about human emotion. It's heavily systematic. Big investors sell, and they don't wait around. Algorithmic trading desks and risk parity funds automatically start rebalancing, dumping stocks to cut their exposure the second volatility spikes. This massive institutional outflow triggers technical sell alarms all over the board, accelerating the downward momentum. So by the time retail investors see their portfolio balance is shrinking and finally start to panic and hit the sell button, they're capitulating into a market that the major players have already aggressively drained of liquidity. But let's bring it home for a second. Section 4. How this affects you. This isn't just an abstract Wall Street issue. This macro shift reaches directly into the structural pillars of everyday life. We're talking about your loans, your mortgage, your business, your investments, and your job. With the average 30-year mortgage jumping past 7% at times, the purchasing power for an average homebuyer has been completely decimated, practically seizing up housing inventory. Floating rate loans, auto financing, small business credit lines, they suddenly turn from useful tools into massive financial liabilities. And as companies prioritize cost-cutting over growth, that robust labor market we've seen over the last few years, it starts showing some very serious fractures. Which brings us to the ultimate threat, a recession. A significant, widespread, and prolonged downturn in economic activity. When the experts look at the threat of a severe contraction like this, they aren't just guessing based on sentiment. They're watching classic leading indicators. Take the yield curve. The spread between the 2-year and 10-year treasuries has been inverted for a historically long period. In the bond market, that's a signal that has preceded nearly every modern downturn. Combine that with the SAM rule triggering, an early indicator based on rising unemployment averages, and you've got highly credible analysts arguing that the Fed's rigid stance is steering us straight into a structural contraction. So, how do the pros navigate this? Section 5. Watching the signals. To survive in a landscape this volatile, you have to do exactly what the top-tier funds are doing. They're watching inflation incredibly closely, and not just the headline CPI numbers. They're meticulously analyzing core PCE, the Fed's preferred gauge, to strip out volatile food and energy costs. They're watching every single Fed meeting, parsing the JOLTS report for shifts in job openings and labor turnover to gauge wage pressure. They're watching every single economic signal. When the central bank explicitly tells you they are data-dependent, reading the nuances of payrolls and manufacturing reports before the broader market does is literally the only way to manage your risk. And the reason for this intense, borderline obsessive scrutiny is just how incredibly fragile the system is right now. It literally comes down to one speech, one policy decision, one inflation report. For a crazy historical precedent, just look back to the 2013 taper tantrum. A single sentence uttered by then Fed Chair Ben Bernanke about potentially slowing down asset purchases caused global bond yields to spike violently and emerging markets to crater in a matter of hours. The market today is wound just as tightly. One unexpectedly hot inflation print or one hawkish slip of the tongue during a press conference can force a massive global repricing event before the closing bell even rings. Which leads us to a fascinating structural question. Will the market recover, or is this just the beginning? Are we simply experiencing a painful but necessary correction to flush all the excess leverage out of the system? Or are we entering a prolonged era where the cost of capital remains permanently elevated? Trying to solve deep supply-side inflation by using blunt monetary instruments like interest rates carries an immense amount of risk. The dominoes of a slowing economy are already in motion, and the true resilience of our global financial system is about to be tested like never before. Keep your eyes absolutely glued to the data, and I'll see you in the next explainer.